All right, hey everyone, good afternoon. It is 3:17. We waited till the crop conditions report came out before making the video so we could talk about what that means and just kind of see what the market how it might react to that. So they did lower corn good to excellent by 6 points down to 55 versus 70 last year. So you've got a 15-point decrease, right, year over year. And so you have the bulls arguing that you can't make trendline yield or beat it if your crop conditions are that poor. And they have a point. The problem is that in June, the correlation to final yield's really not that high. And instead of putting all those graphs up there, what we really need to do is focus on the fact that pollination is coming up here in the next 30 days. And so what the trade's going to look for is what happens with rain between now and then, because it's the lack of rain that's caused a rally and it's nothing else. So you've got to keep in mind that this current rally is not led by demand. It's led by the potential for supply reduction. And so what we want to do is keep in mind the big picture of what that means. So before we do that, I want to put the balance sheet front and center, and then we'll look at weather, and then we'll look at charts, because I think a tradable path is now pretty clear after today's action, and I want you to stick with me and go through that. I'm only going to talk about corn here on this video, and the reason for that is because its critical growing period is coming up. Soybeans have more time. I'm not minimizing the weather impact on beans, but I think corn is front and center because it probably has the most at stake at the moment. Okay, this is what the USDA says our balance sheet is going to look like. Okay, they're at 2257 as of the June report. A few rounding issues over here in the spreadsheet gets us to within 2 million or 3 million bushels, so we'll go with 2255. Okay. Now, if you decrease yield and hold acreage the same, you decrease yield from 181.5 to 177.7 because of the lack of rain. And this number came from Bar Chart, by the way. They put out their first satellite imagery-based crop estimate so far of the season. So 177.7 is their yield. You hold demand consistent, and you're still at a 2 billion bushel carryout. Now, here's what we're afraid of on the bearish side and why we still think our risk is down. If you look back to April, the USDA said our demand was 13.8 billion bushels of corn. Then you fast forward to May and June, and they increased that by over 600 million bushels to 14.485 billion bushels. So they increased demand, and here's what we know is a stretch, is that demand was struggling to get to the 13.8 billion number, and it's certainly not given any measurable metric that we can follow at the 14.485 number. So they built in some slack here, and if you remember back in the May report, we talked about this being a problem for the corn market, because what they did is they sandbagged the yield, because now they can decrease yield and decrease demand and hold the carryout where it was. So if you come over here and you assume that happens, now they won't do it bushel for bushel or anything like that, but even if you take this down to, let's say, 172, now you're saying, hey, a 1.4, oh my gosh, we're not going to go to $3. Well, you might not unless they drop this back down to, let's say, 13.9. Now you're still at a 2 billion bushel corn carryout. So you can lose 10 bushel an acre and still have a 2 billion carryout. So the idea that we're going to shrink the carryout, I think, is way premature given what we know about our demand situation, because it's just not there. And the U.S. corn market continues to become less and less competitive globally as compared to South America because of this rally. So we get further away from the market, not closer to it, which is not going to help our demand at all. You also have oil and prospective domestic demand iffy at best, which puts ethanol in jeopardy. So your demand number is suspect at this and likely not going to go higher. So yield becomes less important. So with that kind of big picture in mind, let's take a look at what the weather is going to do. Let me drag this over here. And I just want to show you this. I'm not going to try to pretend to be a weather person or anything like that. You guys all keep track of it as well as anybody. But I just want to put the longer term forecast in from the GFS here from July. This is out to July 6th. And this is the total quantitative cumulative precip map as published here by pivotalweather.com. Nothing special about this. You can all go to the website and manipulate this data to see what we're looking at. But what this is showing us is this is Iowa, this is Illinois, this is Iowa, right? So you've got the majority of the Corn Belt coming right into the critical pollination time period with lots of rain. You're talking 3.5, 4 inches of rain during this critical time period, which is plenty to get the corn through pollination. Now, maybe we don't blow the top off of the yield, but we're certainly not going to just destroy the crop if this becomes valid and meaningful at all. We're also not going to destroy the soybean crop if this materializes. Now, if it doesn't, and there's no rain in this area, then yeah, we have a problem because our yield is going to come way lower. But the USDA has the room to manipulate the data. They've built themselves in a buffer, and as Phil says jokingly, when they build themselves in a buffer, they absolutely know how to use it to control food prices. So don't just assume that we're going to go to an 800 million bushel corn carryout or anything like that with this type of forecast and the demand numbers that they put on. Okay, now let's look at the charts. Now stay with me here a little bit. I want to talk about waves and I want to talk about Fibonacci. So we have this big impulsive move up, and the market seems to lack clarity and lack direction. And we're also lacking volume today. Today's volume was about 65% of Friday's volume, which was massive, which was also led by short covering, right? So the market is uncertain and it doesn't know what to do. So what typically happens in that instance is we tend to gravitate to Fibonacci support and resistance levels and kind of bounce around among them. So at the end of this, I'll spoil it, what we're going to look for is a cluster of Fibonacci support and resistance levels that we can trade from if we trade down to it. Now, big picture, let's talk about waves a little bit. If you have a big Elliott sequence, that's a 21 wave sequence. Okay, you have 5 up in 1, 3 down in 2, 5 up in 3, 3 down in 4, and 5 up in 5. That's 21 waves. And then the contra to that is a 13 wave sequence where you have 5 down in a corrective wave, 3 up in a corrective wave, and then 5 back down. So you have a 13 wave sequence. Now, what we have here, as I break this down into the smaller charts or smaller time frames for you, is a 13 wave sequence that completed today. Now, I'm going to back this out and pull up the 1 hour chart so you can see this, okay? Now, I'm going to scrunch this up so we can see exactly what it is that we're talking about. Now, I don't plot these numbers. This is all done by an indicator that we have. So there's no subjectivity here at all. It's all just objective math. So here we have 1 up, 2 down, 3, 4. Here's your 5. Here's 3 waves down. And then here's a 5 wave sequence that started right before the gap last week at 520, 1, 2, 3, 4, 5. And now this morning, today's action unfolded in a 1 wave down, okay? So you have a 13 wave sequence from the low all the way up. So what comes next is really, really important, because if this holds as a 13 wave sequence and is a top in a corrective pattern, then what comes next is a 21 wave down sequence, which is super bearish, okay? And if you see the rain forecasts and you see the carryouts that could materialize from that, that is where we tend to lean, because it's in line with what we understand the fundamentals to be. You know, this is not the bull market of 2020, which had demand roaring and beating USDA estimates and crop supply issues. You know, in that year we had both, and that's why we had the strength in 20, 21, and 22, because we just couldn't get ahead of the curve. But this year we have a known big crop in South America, we have known rain chances coming, we have known acreage, and we have known poor demand. So I think what's most likely coming And maybe this is the peak. Maybe we got to go one more little extend this fifth wave up a little bit more. But the reality is, what's more likely than not is a 21 wave down sequence. So where might that come from, and how will we know? Okay, so first off, what we want to do is we want to look at Fibonacci retracements, because we know that after an impulsive move up, we tend to retrace a Fibonacci retracement level, right? Which is a 38.2, 61.8 are the two major ones. So if we snap a retracement tool from the last wave 4, where we have is a 38.2 at 584. Okay. Now, if we come just a little lower and go from the origin of this last impulsive move up, then our 38.2 retracement drops down to 575. Now, I want to leave that on there because it's a little bit bigger perspective, and it puts us, I'm gonna take the first one off. So keep in mind that 582 level, okay? It's important, but I'm going to keep the chart relatively clean and take it off for now. Now, another thing that's helpful and important here is this morning's decline was met by a rally back to 61.8, okay? So here's the overnight high, here's the decline from the overnight session, here's the rally that took place this morning, and we've stalled right at 61.8. And this is in a wave A position. We should get a B and then a C, or we'll just continue on down. Now, wave A and wave C are most often equal distance, and sometimes wave C can exceed it by 31.8 or 38.2 beyond that, okay? So if you take this number, 609 down to 588, that's 21 cents. You take the peak of we take the peak of B here, and we go 21 cents from here. We go down to 581, right, which is right here, which, if you remember, was the 582 was the 38.2 of this wave 4 that started here. Okay, so stay with me. So now you have 2 points, 38.2, and you have an equality of wave C to A. And then if you take that plus 38.2, because a lot of times wave C will exceed it, you drop right down in here to this 75 level. So that's a long way to explain that our target and where we want to see the market push through or reverse from is 582 to 575. That's our target level. And that also coincides with two other critical points. One is this bottom of the 60-minute cloud, and the second is this shelf that we've talked about for several weeks right back here at 575 that sits right back here. So somewhere between 82 and 75 is where we want to see this market trade to, and then either reverse from and begin a new wave sequence higher, or this is where the rain could materialize and confirm, and we just roll on over and come on down. So this is a great opportunity to make sure that you increase hedges, that you recognize that the downside is still very realistic, even though we have a lack of rain. Because personally, we've been talking here in the office, we don't see how you can sell it fast enough if this rain materializes, because a 2 billion bushel carry out, or the threat of one, is not worth $6. It's worth $4.50 or less. So the risk to your balance sheet is still down, not up. So after all of the craziness, we can boil it down to a 5-cent range that we want to see it trade down to. So if you're caught in a long position and you want to get out, that's where you do it. If you're not sold and you want to get more hedge protection put in place, this is where you should put it on, right here. But make sure you have calls on, because anything can happen. And we're certainly not trying to predict the weather, but if we do trade down into this area, short futures, long calls is an ideal spot to be, because it gives you the best of both worlds, keeps your upside open, and protects you to the downside, okay? All right, that's 15 minutes. That is a... oh, Jeff's whispering in my ear here. If we do roll on down and we come all the way back down below this, this is where you want to start selling calls again. So you can sell 560, 580 calls depending on what happens here. We really haven't seen the call premium accelerate the way we would have liked. That's why I think buying calls or just selling futures is better than buying puts, because I don't think the puts are going to behave real well with as expensive as they are. So we want to be short futures, long calls, and if you're super aggressive and want to collect premium, you can sell calls down in here. And if you're long calls, this is where we'll look to exit those as it rolls over and breaks. But that's all dependent on rain. And if you look at that forecast, you know, that's right here. So if we meander down into this area and chop sideways down into that 575 area, and the rain materializes, I think it's good night corn. If we don't see it materialize, or we start to turn dry as we trade down into here, then it's up and away we go, and we're going to blow up out of here pretty fast. So lots of important trade activity coming, and you got to stay on your toes and stay with us, because this one accelerated really fast last Thursday and Friday, right? And we weren't fast enough to come out of all positions, but from this point forward, the market's going to give you an opportunity to get reset, and that's what we want to see happen. All right, that's 16 minutes. That's just corn. We'll do beans and wheat probably tomorrow, but we want to see more trade action, and we want to see how the overnight goes first. Hope you guys have a great day. Remember, there's risk trading futures and options, and you should only do so in light of your own financial condition. Have a great night. We'll talk to you later.